Hello, everybody. I welcome all the members of WBAF. Good morning, good afternoon, good evening, depending upon where you are. And it's such a delight for me to welcome you all for this webinar, this workshop rather. And I must thank our chairman, Mr. Bebas Altunas, for organizing this. So when I was talking to him a couple of months back, he how much he is so much into our community. He breeds our community. He is always thinking about how we can make our community become more and more strong, and he identified opportunity whilst talking to me, and he told me that, Kuntal, why don't you take up a workshop? With your knowledge and experience in this space, it can be very meaningful for all our members of WBF. So that's the backdrop to this today's workshop. And I'm trying to give an overview on general challenges which every startup or the startup ecosystem would face when they're looking at successful exits. So what I intend to do is cover in today's session. So we have a scheduled time for close to 120 minutes. I don't think so that I'll need that full 120 minutes of time. I'll try and give overview of some of the important topics, and then maybe we can at the end leave some time for Q&A, where I'll be more than happy to provide my views on any questions or any comments which you may have. So what I intend to do today is just first of all give an overview of the startup space, startup ecosystem, and how the startup system is becoming more and more relevant, and how it is playing meaningful role for all the developing countries as well as for developed economies. Since the topic today is the tax and regulatory challenges for successful exits, I'll try and give an overview of some important concepts. And when I give overview of important concepts, I'll try and eliminate a lot of technical jargons and technical rules, regulations, so that we can understand this particular subject in more practical manner, and we can apply this particular learning for our day-to-day life. I'll also try and give some case studies with regard to how and what we have experienced in the recent times with regard to some of the exits and some of the concepts which we have for the purpose of startup ecosystem. I'll also give overview of what kind of role one advisor should adopt, so that the client could be either the founder of the startup, or the client could be the investor who is looking to exit from the startup. What kind of role one advisor should follow, and also as an investor, whether we are an angel investor or whether we are family office, or whether we are looking at portfolio investment, what kind of responsibilities we have as an investor, and what role can we play as an investor, so that we can contribute meaningfully to the overall growth of the startup and the startup ecosystem. So personally, I also make some investment as an angel investor in few of the startups, and I feel that that is one of the ways to learn very closely on how the startup is dealing with various challenges and what kind of opportunities one can identify whilst working closely with the startups. So let me first give an introduction to the startup space. So let me put one simple question. If you were to tell me as as a consumer, or as a client, or as a retailer of any product or service, what would straight away arouse your interest? What you would want to listen to, or what you would be interested when you are taking a role as a consumer, as a client, or as a retailer? An answer to that is that if you are able to listen from somebody a way to solve your problem, a way to deal with your problem, with your challenge, you will give total attention to that product. You will be subscribing to that product or service. And that's the philosophy under which the startup founders and startup ecosystem operates. Startup ecosystem, basically they try and identify problems and they come up with innovative solutions. They come up with solutions which can improve the efficiency in the given business proposition and which can then provide meaningful engagement for all the stakeholders. And if we talk about this particular proposition and this approach of the startup ecosystem, there are so many examples which I can think of. If you look at on a global map, you would be familiar with so many of that successful stories. And globally, those successful founders are today part of mainstream business, mainstream multinational enterprises. What would have started as a simple startup, and usually when we talk of startup, we talk about somebody starting a small initiative back in some garage or in some small office. And from that particular status, they have now reached today to a global conglomerate or from a multinational, multi-billionaire company. And few names, I'm sure you all are familiar with such startup success story: Airbnb, Uber, Facebook, WhatsApp, Netflix, and list can be it can be very, very on. And also, if I talk from my home country where I'm coming from, India, there are so many successful startup stories, whether it is to do with technology being used for the payment gateways, so PhonePe, Paytm, Practo, Boat has become a global phenomenon, and it's also something which can compete with likes of Boss and other service providers, Dream 11, Swiggy, Nika. There's so many names which crosses my mind. And the reason why I'm giving all this background is for us to understand that this successful businesses and successful founders offer win-win proposition. And when I say win-win proposition, it means that it is going to provide an incremental value to the given business, which would lead to increased business volume. With the use of technology, they will be able to improve the efficiency, and their ultimately objective would be that there will be increase to bottom line, and which would then translate into money. And when we talk about money, everybody gets interested. So whether it's a multinational company which is catering to their business needs, they are also looking out for founders or startups who are trying to address to any problem which is part of that particular business. So they are looking for some opportunity whereby they can acquire that founder, acquire that platform, and increase that market share. Then there are investors. Naturally, when we talk money, investors would come to our mind at the first instant. Investors would look for an opportunity wherein they can deploy their funds and increase their return on investment. Governments, we have seen, especially we talk of developing economies or also developed economies, they give specific attention and emphasis to the startups, because by now they've realized that startups, the young founders, young entrepreneurs will be able to deal with grassroots challenges and problems. And such support by the government to these founders can not only facilitate founders to grow their business, but it can also help government expand its GDP. It can also help government to collect more and more revenue so that it can meet up with its obligation, social obligations, or other obligations towards the community. And that's why when there is a win-win proposition, everybody gets attracted. And if you look at number of unicorns which have been created in the recent past, figures are just before you in the screen. And unicorns, as I'm sure you all know, is a company where the valuation of that company has crossed $1 billion. So we have seen in year 2021, which was the peak of our COVID situation. And in that scenario, one would have thought that businesses would have suffered. One would have thought that how people would be interacting with each other. But look at the chart. We have seen the highest number of unicorns in calendar year 2021 across past 10 years. When you look at 2022, this chart provides only for first 6 months of financial year 2022, where number of unicorns globally have crossed 200. If we see the region-wise contribution or the placement of unicorns across world, no doubt today it is very heavily in favor of North America. We have seen that close to 631 unicorns are from North America. Asia is not behind. China, India, and like South Korea are another countries where there are so many unicorns who are coming and who are playing a big role in the overall development of the economy, followed by Europe and also some percentage in Latin America. The Global Startup Ecosystem Index has also kept on increasing its score. I have just selected some 5 select indexes where the score of every index in past few years have just gone up. Now that was the background, and the background was necessary for us to understand the relevance of startup ecosystem with so many startups turning into unicorns, so many startups who are in the phase of unicorns, offering great opportunity for everybody to become part of this startup ecosystem. And the objective of everybody joining in the startup ecosystem is to maximize their investment, is to maximize their opportunity by being part of this particular growth story. When you talk to fund managers today across all countries, you will find out that there is a very clear indication that every HNI or every family office or VCs are ensuring that some part of their portfolio is allocated towards investment into startup. And with that background, I think let's look at some important concepts as far as we are looking at what kind of tax or regulatory challenges we can have at the time of successful exits from founders. So when we talk about exit, it presupposes that the investment by the investors into startup was a very good decision. The identification of the solution by the founder of the given problem was also very apt. And because of all other circumstances, now that startup has resulted into a place where it has become very popular, very attractive for investors to capitalize or for founders to exit. And when we talk about exits, we have to look at few important concepts. And when we talk about exits and tax, again, there are a few important concepts which we need to keep it in mind. First and foremost is the concept of cross-border transaction. Because when we are talking about global forum of angel investor, we need to be cognizant of what is something relevant is cross-border. So when I say cross-border, which would mean that in a given business transaction, there are more than 2 countries which are involved. So in other words, you may have a cross-border proposition where a business of a founder is established in one country. It could be, say, in country India. That's where the founder has established the startup. And the other country could be the investor country. So look, suppose the investor happens to be in Europe, or maybe in specifically, if you were to pick up a country, is in say France. So France is a country of investor, and India is the country of the founder. So that this kind of a financial transaction is a cross-border transaction. So important point to be borne in mind is that tax or the other challenges will become very relevant when it is a cross-border transaction. So startup is at one place, investor is at the place, and some dimension can also be added to that, where the founder of the startup may be at some other place. So in the example which I gave, that the startup is based at India, it is very likely that one of the founders of that startup could be residing maybe in Germany. So Germany is a co-founder jurisdiction, India is a jurisdiction of the founder, and France is the jurisdiction of the investor. So this is typically a cross-border setup under which we'll have to then examine the implication of the tax or other regulatory challenges. When you talk about tax, I think important point would be also that tax will get triggered when there is a taxable event. So unless there is a taxable event, there will be no tax challenge. And what are those typical taxable events when we talk about exits? So one could be the investor based in France is selling the shares of the Indian company to some other investor, and that investor could be again in US or could be in Singapore. Or because of the personal circumstances, the France investor may want to gift away that particular share in favor of somebody. And depending upon the rules and regulation of France in this example and India in this example, that particular gift could also attract some kind of a tax in the hands of parties involved. There can be some corporate action. For example, the founder company may enter into some kind of a swap of shares proposition, or may get into some kind of demerger or some kind of other corporate action, which can also lead to some kind of event of taxation in the hands of founder or in the hands of the investor residing at France. And there could be any other mode of transfer or issue which can trigger tax in the hands of the parties involved. Now, tax, when there is a taxable event, it will give rise to tax incidents in the hands of transferor, or it can be the hands of the company, or it can be hands of the founder, depending upon the transaction and depending upon the contribution and role being played in that event by the parties. And there are countries, I think by and large, every country would adopt worldwide taxation. And when I say worldwide taxation, it means that every country would like to tax its residents on its worldwide tax, irrespective if that income is arising in that country or in other country. So if I was to continue with that example, a France resident may be subject to tax in France on the worldwide income, including any income which would arise to France investor from transfer or sale of shares held by France resident into the shares of Indian company. There could be also situation where the country may follow territorial taxation. In other words, the tax can arise or tax incidents can arise only when the transaction or the event takes place in the territory which is going to have a tax incidence. Additionally, there can be some taxing rules where tax can be applicable only when remittance of that particular income arises in that particular country. And when we talk about taxable event, when we talk about tax incidence and the scope of taxation, we have to also take into account the residential status of the concerned individuals or concerned entities. So when we talk of startup ecosystem, typically we are looking at investor, we are looking at the startup entity, we are looking at the startup founder, and we are looking at a new investor. So depending upon the nature of transaction and the role and the contribution of the parties concerned, the tax event can take place. And because of taxable event having taken place, we'll have to examine the residential status of that particular party and then look at the tax. So continuing with the same example, for India, if the resident France investor is selling shares of Indian company, then India can tax the income arising to France resident in India, even though the France resident is not a resident of India and is resident of France. And that gives rise to taxable event. And that's how we look at the residential status of the parties involved. At times, it can also be necessary to look at the tax residential status of the investor entity. It is very likely that investment may not be by an individual into a startup, but investment could be by an investment fund or by an investor entity into the startup. And at that particular circumstances, one will have to determine the residential status of that investor entity. Then there are some typical exit routes which will also give rise to taxable event. One and very standard would be sale of shares. And when I talk about sale of shares, it's a transaction where either the founder will sell the shares of the startup, or it could be a scenario where the investor may sell the shares held by the investor into startup, or it could be mix of both. And such exit will give rise to a taxable event, and depending upon the residential status and the tax incidence as per the rules of that country, the tax liability may arise. Similar exit route could be M&A activity. So in M&A, what I mean is mergers and acquisition. So in merger and acquisition exit route, typically a startup entity would be taken over or would merge with any other new entity or any other existing entity. Now, by and large, there are many countries, including India, France, or for that matter, very developed countries, they provide tax neutrality for the purpose of M&A exit routes. So by and large, if the transaction of M&A meets with the specified conditions and the rules, then the M&A will be tax neutral transaction, and it is very likely that the parties involved in the transaction may not be subject to any tax, even though there is some kind of an exit. Another exit route is IPO, which is the most desirable way of founder to bask under the glory of their success. Every founder would dream of the day when their company will get listed on a stock exchange. So IPO is initial public offering, and there can be a scenario where investors or founder may be able to sell some of their existing shares at the time of IPO or at the time of listing. This could also give rise to taxable event, and this can be also one of the very popular exit route. Another exit route could be on account of liquidation, and that could arise under general circumstances where the founder may not think it necessary for them to continue with the company, and in that case probably the company will go through liquidation, and in the liquidation there can be some surplus which can be taxed in the hands of the parties concerned, and that is one way of exit which investor can obtain by their investment. Character of income is also a very important determination of the tax liability. Whether the income is a capital gain, whether it's a business income, or whether it is a dividend income, will determine the tax incidence and the tax liability of the parties involved. Now, there are many technical analysis and technical interpretation, which I don't want right now to deal into a greater length. Suffice to say that depending upon the circumstances under which investor has invested into the given startup, the character of income for the investor could be either capital gain or business income or dividend income. And the resultant of such characterization will determine the tax in the hands of investor in the concerned country. Then there are also certain exempt transactions. As I mentioned, one could be M&A. M&A can also give an exemption. Similarly, there are few provisions in many countries where they may not levy tax on certain transactions if it meets with the specified conditions of the domestic law. Treaty rules may also provide. When I say treaty rule, it's a double. It's a treaty is for elimination of double taxation between the contracting countries. So the example which I give would be, say, India and France. And similarly, India has few treaties where a non-resident selling shares of Indian company to another non-resident may not be subject to tax in India. There are, however, certain conditions and certain rules which one will have to comply with. But the point which I'm trying to make is that there can be a taxing rule under the tax law of a country or of the relevant tax treaty, which may not fasten any tax liability for the parties into the concerned country. Similarly, gift or transmission may not attract tax in the case of that transaction. Then another concept related to exit through buyout deals. Here again, it's extension of merger, but in buyout deals, what will happen is that the existing shareholders, which could be the founders as well as the investors, may not continue to hold the shares, or they may not continue to remain involved into the business. The entire shareholding can be purchased out by the new investor. So this is some relevant factors, relevant concepts, which are very important, because when you talk of exit into a startup, from a startup, this particular slide and the concepts which we have captured here are very relevant, and this would determine the tax challenges for the founder or investor in the concerned jurisdiction. Now let me go through some of the case studies so that the concepts which I tried to give can become even more relevant and can also become more practical for your understanding. We touched upon the concept of residential status and the tax liability arising to that individual or company in the given country. And as I mentioned earlier, that by and large, we will see that the rules of the country would be such that all the residents of that country would be subject to worldwide income tax. So that is determined on the basis of residential status. So whether you will be subject to tax in your country of residence with regard to your worldwide income or not will get determined by the law of that country. And by and large, all countries will provide that residents of that country will be subject to taxation on the worldwide income. And there is one exception, and that comes from USA. And USA law provides that a citizen of USA, whether that citizen is residing in USA or is not residing in USA, he will be or she will be subject to tax in US on his or her worldwide income. So typically, say a US citizen who has moved out of US for the purpose of employment or the purpose of any other vocation, and he's residing, say, in Singapore. But since he's citizen of US, he will be subject to tax in US all the income which he may earn, whether at Singapore or at US. Then that becomes very important element. And we have seen that there are few challenges which few of our clients are also facing when it comes to tax exposure which they may have in the country of which they are citizen. Then there are certain exemptions and incentives which are available for the purpose of promoting the startup, for promoting the founders. And those exemptions and incentives can be very much unique for the given country. Now, in India, for example, a startup company is able to have tax-free income for the given defined period if they meet with certain conditions. And also, there are certain exemptions that if the gain arising to the investor from the sale of shares of a startup, then those particular gain amount can also be exempted from tax if they apply that amount of gain in a defined methodology. So again, that becomes a relevant and very typical point for any investor or founder. We have seen cross-border M&A giving rise to a lot of challenges, not only from tax, but also from other point of view. If we talk of tax, there's a very famous and popular case study dealing with Flipkart, the Indian company, and Walmart, as we all know, was one of the promoter shareholder of Flipkart. And when they exited Flipkart, there was cross-border M&A, and there are tax challenges which are being dealt by Walmart on account of the tax provisions and tax rules of India. We have also, heard about the ongoing competition law proceedings for Microsoft for acquiring the Xbox platform through Activision Blizzard, and that particular problem is still live. And the case study here is for us to keep this in our back of our minds, that when we are looking at cross-border transaction, we will also have to take into account not only tax law, but some other provisions as well, which can create some kind of practical difficulty or challenge for the parties involved. One of the very practical difficulty, especially for the developing economies, is coming from the foreign exchange regulations, because there are many countries where there is restriction for the flow of foreign funds inside the country or from country to outside. So repatriation of profit can also create some kind of a challenge. So that is also something which one will have to be mindful of, that if the investment has been made to a jurisdiction where there are some kind of a capital account transactions are monitored or are restricted, the sale proceeds or the repatriation of the full amount of consideration may have some difficulty as far as the transaction is concerned. Another case study comes to my mind is for indirect share transfer. When I talk of indirect share transfer, typically what happens is that there is no direct transfer of the relevant shares of the startup, but a one level above the operating entity, there can be some transfer of shareholding. So if we continue with our example, where we looked at France being the jurisdiction of investor holding Indian company shares, and if the France investor was not individual but was a company, so France company holding shares of Indian company, and there is a transaction of indirect share transfer in such a way that the shareholders of France investment company undergoes change. So Mr. A, for example, holding shares of France investment company, sells the shares of France investment holding company to Mr. B, then that's the case of indirect share transfer. And such indirect share transfer could also attract tax liability for the given transaction. And one will have to look at the relevant tax provisions, the treaty provisions, to conclude on the tax liability, which may be fastened on the concerned parties. Another case study which I can think of is the fair market value of asset versus the fair value. So when I talk about this, it's a concept where the transaction of exit may get concluded at a negotiated price between the parties, but it's very likely that for the purpose of taxation, the law may prescribe its own methodology to arrive at the fair market value of that particular share which are proposed to be transferred. And in such scenario, the parties may be subject to higher tax liability if the value of transfer, as per the rules of the relevant country, provides a higher value in comparison to the transaction value. Similarly, we'll have to also take into account some experience of angel investors. I am one of the angel investors, and if I was to share some of my uh, experience on investment into startup, I would say that most of the times the initial transaction documents uh, are not kept in order by the angel investor, and when they are looking at the scenario of exit, they struggle to meet up with the necessary due diligence and also necessary homework, which can help them to improve or ensure that their tax liability is efficiently dealt with. Another could be feedback of tax policymakers. Uh, I have been interacting with uh, a few of the officers working in the Ministry of Finance, and I was quite overwhelmed to learn from them that how they look so minutely and closely on the pain points of the founders and of the investors, so that they would like to extend a conducive and also supportive policies so that it can help startups to prosper and which can indirectly support the whole economy. Likewise, I'm sure that other countries and also policymakers of other countries will also have their own way and their own focus with regard to supporting the startup ecosystem. And in this context, I think it would be also relevant for us to obtain feedback of our community. Our angel investment forum, we have a huge, rich number of investors and investor community. And I think feedback from them with regard to the kind of challenges they have experienced can also be kept into our consideration so that we can ensure that we are able to learn from such feedback of the community. And I think that's one of the areas where I'm sure our chairman would be also looking very carefully as to how we can establish ecosystem wherein the community can provide their feedback, and with that feedback we all can empower ourselves and we can improve on overall efficiency for our investments as well as for our founders. Having said that, I think I'll touch to next topic with regard to what role an advisor should play in order to ensure that the exits by the investor or by the founders are tax efficient. And I think the most important aspect there, this is also based on my personal experience because I have been advising founders as well as investors. And I think this are few very important considerations which every advisor should be taking into account. So first and foremost would be the data and fact compilation. As I had elaborated earlier on few of the important concepts, it is the responsibility and the role of advisors to ensure that they have taken into account and they have compiled all the important data and facts concerning the investment by the investor or by the founder into the startup, because those data points and those factual analysis will help advisor to try and provide tax efficient and tax optimal solution. Another thing would be, after having compiled the relevant data and facts, important point would be for the advisor to identify which are the rules, regulations which would be applicable to the given transaction, whether the given transaction will trigger any of the other statutory provisions, whether it would trigger any deemed taxation provision, whether there are any exemptions which can be availed by the parties. So these are a few of the important analysis which advisor will have to carry out. Having identified certain rules and regulations, the advisor will also have to thereafter do analysis of available judicial precedents, so that even though there are certain rules and regulations, if there is any ambiguity surrounding the interpretation of a relevant provision, the advisor will have to find out if there are any judicial precedents which can help him eliminate such ambiguity and reach to a consensus which could be useful for the parties. And this itself can be a backdrop for advisor to reach to a sound advice. And he should document all those particular backdrop and rules and regulations and provide support to the advice. We as a part of community, we also need to ensure that we are able to have our own predefined steps, processes, SOPs, so that any advice which we may give to our clients is well documented, so that it can be of uh, importance as time comes by. Advisors should be proactive, and this is, I feel, is the most important part, where one should not wait for the 11th hour or the last hour, where advisor would then go to the parties and ask them to carry out certain specific activities, some specific tasks, because proactive approach will ensure that the transaction gets executed in a seamless manner, in a smooth manner, and they will be able to provide the desired outcome. And most important role for the advisor would be to ensure that tax efficiency is achieved, and at the same time, the transaction is fully compliant with all other applicable rules and regulations. This was the role as far as advisor is concerned. And now, if we were to take up a role and responsibility as an investor, there is something which even we need to, as an investor, bear in mind. And I think the most important is to do our due diligence before making investment. I have seen many times that the investors would come to me with a problem, and those particular circumstances, I would have felt that that problem could have been eliminated had the investor carried out his own due diligence before making the investment. So whilst there is an opportunity and there is always a kind of a time critical decision which the investor will have to carry out for making the investment into startup, but with nevertheless, it is important for the investor to carry out his or her own due diligence before making investment. Investor will also have to have his own investment thesis. It's not necessary that because some other investors have taken exposure or have invested into a given founder, you as an investor should just invest by closing your eyes. That's not right. I think one will have to be clear on what is the investment thesis which investor would want to adopt for the given transaction, and that can be the basis for the investor to decide whether he or she will go ahead with the investment or not. Most important other point would be for the investor to be clear with the investment structure, because this investment into startups are typically for a long term. It could be at least in the range of 5 to 10 years. And if one is looking at investment for such a long duration, the investment structure has to be robust. Investment structure has to ensure that it would facilitate the future opportunities and future growth for the investor. Because many times in my personal capacity, I've seen that lack of having that foresight can create some difficulty for investor, because once investment has been made from one particular vehicle, it becomes very difficult to undo what would have been otherwise not a right strategy. Record maintenance, and this is most important matter, because if the data and the records are not maintained appropriately and accurately by investor, he will find extremely difficulty in evaluating the pros and cons of exit and the capital gain or tax exposure through the exit, because there is no such thing about having proper historical documents. Investor will have to ensure that throughout the tenure of investment, they comply with necessary obligations. So ongoing compliances and reporting at the home country as well as at the source country or at the target country jurisdiction, as it may be applicable, is complied, because any non-compliance or any default could fasten some additional challenges and at time penalties for the investor. And last but not the least, investor will have to ensure that they look at the exit strategy very carefully, and they evaluate opportunity in such a fashion that they are able to implement the desired tax efficient strategy with the help of expert and with the help of advisors. I think this was some overview with regard to this important topic. Uh, I tried and kept it on a very generic term rather than jumping down at a very technical terms. And I now invite questions. I keep the floor open for Q&A so that it can be very meaningful for all of us to have practical challenges being discussed, which can be very meaningful rather than keeping only on an academic side. So if there are any questions, kindly either you can put it in your chat box, or maybe you can raise your hand and you will be allowed to raise the questions. I see there is a question there being raised by Asril Sattar. Is there a way for him to raise a question? Yes, please go ahead, Asril. You are unmute. Please unmute yourself. Asril, can you unmute yourself and raise your question? No, maybe you can type, Asril. I think not able to hear you. I don't know if you're not able to mute yourself, unmute yourself. You want to raise a question?